Welcome everyone. My name is Shona Sherman. I am the Director of HFB. This is actually our very first webinar, sorry. Welcome. It's a pleasure to have you here. We've had a few requests to have our webinars recorded live. This is our very first one, so please bear with me as I'm a little nervous. But we've got some slides to go through with you today, and we will welcome your feedback after we've finished. We hope to do more of these in the future as well. This meeting is being recorded, and a recording can be sent to you along with the slides afterwards. And we have muted, because it is being recorded, we've muted everybody and cameras are off. If you've got any questions during our presentation, please don't hesitate to put some questions in the chat box and we will try and get to them at the end if we've got time, and or if not, Danielle or myself will get back to you after in the coming days, I guess. Okay, like I said, my name is Shona Sherman. I'm the director here at HFB. And we're also joined with Danielle is also joining us. She's the Associate Director here. And for those of you who've got an SMSF with us, you would be speaking with her a lot because she manages the administration and compliance side of the SMSF. All right, here's just a little disclaimer. Anything that we talk about today will be general in nature, doesn't take into consideration your personal investment objectives or financial objectives. So it's not personal advice, it is general. If you do need any personal advice and want to take into consideration your personal objectives and financial objectives, please get in touch or see a financial advisor. So some of the things that we're going to cover today, we're going to talk about super contributions, including deductible contributions and non-concessional contributions and some different ways that you can do that. We'll touch base on what the minimum pension requirements are. We're going to have a bit of a chat about related party transactions and how they affect SMSFs, and also look at some strategies such as withdrawal and recontribution. Here are some key superannuation amounts that the biggest ones to focus on are the change to the deductible contribution limit, changing from 1 July 2024. So currently the concessional or deductible contribution limit is 27,500. That is increasing to 30,000 from 1 July for the 25 financial year, which also means there'll be an increase in the non-concessional cap. Currently that's 110,000, and that's going to go up to 120,000 from 1 July. That also means that the bring forward provisions will go from being 330 maximum to a maximum of 360,000. Transfer balance cap at this stage remains the same at 1.9 million. There is talk that may increase throughout the year up to 2 million. We've got employer contributions. That is increasing. So currently the standard rate is 11%, and from 1 July, employers are required to pay 11.5% on employer contributions, and it will go up to 12% from 1 July 2026. So these are mandated. And any employee, if you are running a business and you're employing people, or even if you're running a business and employing yourself, contributions are paid. So super guarantee is paid to everybody who is over 18 years of age, no matter how many hours they work. If you have an employee who's under 18 years of age, you're only required to pay super guarantee if they work for more than 30 hours in a week. There's no maximum age limit, so if you've got an employee who is 83, you're still required to pay super guarantee. Some people like to salary sacrifice, and employees can do that up to the age of 75 years. That however much they salary sacrifice goes towards their super contribution limits, and so it's up to them, I guess, to have a look and make sure they're not going to exceed those limits. And if they do make salary sacrifice, it doesn't go towards your super guarantee requirements. So it's in addition. So personal deductible contributions is the limit's the same as if you have an employer contribution. So your limit that you can put in is $27,500 this financial year up until the 30th of June. And then it's going to be $30,000 from 1 July. So members aged up to 75 years, they can make a deductible contribution up to this limit. There are some restrictions once you turn 67 in terms of needing to meet the work test, and I'll go through that in the next slide. So contributions are typically counted towards the relevant cap in the year in which the contribution was received. That is, unless you're using, for example, a contribution reserve, and we will look at that in a little bit later as well. If you do make a contribution and you want to claim a deduction for it in your super fund, you do need to ensure that you have a signed notice of intent to claim a deduction and that notice is provided to your super fund. Where you have an SMSF and that we are looking after, then we can help you with that. But if you are putting money into a public offer fund, for example, then you do need to make sure that you have a signed notice of intent to claim a deduction so that they're aware that that's what you're wanting to do. There are also catch-up contributions available for members whose total super balance is under $500,000 at the previous year, and we will touch on that a little bit later as well. An important thing to note for this year is that the 30th of June falls on a Sunday, so it's you need to make sure that contributions are made to the super fund before the close of business on the 28th, the Friday. If you don't do that, they won't be deductible in this financial year, so and won't count towards the cap. So just bear that in mind, that our last day is actually going to be the 28th of June. Work test eligibility. So this is for people who are aged between 67 and 75 years of age, and it's only applicable if you're wanting to claim a deduction in your super fund for a contribution you have made. So if you're aged between 67 and up to 75 years, then you must have worked, or your 75th birthday, I should say, you must have worked at least 40 hours in a 30-day consecutive period. And that includes, it does need to be gainful employment. So it does need to be for reward. So you actually get paid for the work. So unfortunately, volunteering your time, for example, at a charity isn't considered gainful employment. So, so that wouldn't meet the work test. There's also a one-off exemption available to the work test, and that is if you meet specific conditions, such as that you have satisfied the work test in a previous financial year, and that your total super balance is less than $300,000 at the end of the previous financial year, and you've not relied on a work test exemption in a previous year. So that's sort of for people who are retiring, and in the next financial year they can make a contribution as long as their total super balance is less than $300,000 and they did meet that work test the previous year. This is so here we've got some information about carry forward contributions. I'm going to hand over to Danielle and she will talk you through how carry forward contributions work.
Thanks so much, Shona, and welcome to everybody who's joined us in the last couple of minutes. Carry forward contributions. This is a really good concession for people with low balances. So if your total super balance as at 30 June of the previous financial year was under $500,000, then you're able to use what we call catch-up contributions. So if you haven't used all of your entitlement to the $27,500 or $25,000 in the past, then you can catch them up this year. You're able to go back 5 financial years. So we're currently able to go back to 2019, and that'll be dropping off when we get to 30 June. So then we won't be able to use any unused cap from that year anymore. How do you know what your caps are? So there's 2 main ways that you can find out what your caps are. The first is you can get in touch with us. The other is you can jump onto your MyGov account and then choose the ATO and your super reporting. And there's a couple of slides there that show what the screens look like. And you just pick the financial year that we're currently in, and it'll tell you what your unused balance is. Just note though that where your super is in a SMSF, the ATO sometimes can be quite slow in updating your information on your personal page, particularly if we've just lodged your SMSF return around the 15th of May. I know definitely that the data is still not updated in there. So in that instance, we're probably your best port of call.
Excellent. Thanks, Dan. So I run through a little bit of an example for this. So in terms of your carried forward contributions, as an example, if in this financial year we're sitting in and you haven't made any contributions as yet, but last financial year you received $10,000 from your employer, and the previous year you also received $10,000 from your employer, and you made no other deductible contributions, then and maybe the 3 years prior to that you either didn't meet your limits as well, or you did your limit. So what it does is anything that was unused. So last year the limits were $27,500, and if you contributed 10, that means you haven't used $17,500. So you can add that in, and 17,500 from the year before if you'd made 10,000. You add those together plus the 27,500 for this financial year, and that is the maximum that you can put in. So it does allow some flexibility in getting a bigger deduction in your personal name if you've got a situation where you've got a large taxable income in a particular year. For example, if you've had a capital gain from a sale of a property or some shares, and you want to mitigate that personal tax liability, there are sometimes some ways that you can get a bigger deduction. Another thing you can do is contribution reserving. So this allows a member to make an additional contribution in the June of a financial year and hold that amount in a reserve account until the start of the next financial year when it's allocated. So what this means is that you can make, if we were to look at this financial year, the maximum you can make is the $27,500, unless you're eligible for carry forward. And next financial year, the limit is $30,000. And if you are not thinking you need to make big contributions next year, but you've got a large taxable bill this year, your income is larger, and you think, I really would like to mitigate against that, then you can look at doing a reserve where you put in $30,000, so your cap for next year, and you can use that as a deduction for this financial year, including plus the $27,500 for this financial year. But we don't allocate it to your member balance. So you're not going to break your cap. You're not going to go over your cap for the $30,000 because we put it in what is called a reserve. So it's only counted towards your cap in the year that's allocated, and we can allocate that 28 days after the end of month. So that would be July. So it would go towards your cap in July, but it's deductible in the year that it's received by the super fund. It's also included in the assessable income of the fund in the year that it's received. So if there was $57,500 received this year, then the whole amount will be assessable income in the super fund. It'll also be a deduction in your personal name, but only $27,500 will go towards a cap, and then 30,000 goes towards your cap next year. It is also only counted towards your taxable income for Div 293 purposes in the year it's allocated as well, which is quite good. So, like I said, it's particularly useful for members who've got a large taxable income in one year and are not expecting the same the following year. Particularly beneficial for people who've got large capital gains, or it's their last year of employment and they know they're not going to be working, so therefore won't need the deduction going forward. You do need to be eligible to make a deductible contribution, so under 75 years of age, and if aged between 67 and 75, you do need to have met the work test. You also need to ensure that your trust deed allows the strategy, and that you have the appropriate trustee resolutions and reserving strategy documents prepared and executed. If you have your SMSF with us, then you can get in touch with us and we can assist you with that sort of documentation. Non-concessional contributions, as we mentioned at the start of our webinar, the contribution limit is currently 110,000, but from 1 July it's going up to 120,000. So there are some limitations in terms of being able to make non-concessional contributions, and that is dependent on your total super balance. And total super balance is all of your superannuation balances across Australia. So not just in one fund, but across all of your super funds if you have multiple super funds. It also does include if you have a defined benefit pension scheme as well. There is a calculation to determine what that contribution towards your total super balance is. So the limitations are, if you do have a large member balance and you're wanting to make non-concessional contributions, there is just some information here as to how much you can make. So if you have less than, for this financial year, less than 1.68 million, you can use what is called the bring forward provision and do up to 3 years of contributions. And that is, so that's 330,000. If you are wanting to make contributions and you've got a member balance between 1.68 million and 1.79 million, you can make up to 2 years of contributions, which is 220,000. If your member balance is between 1.79 million and 1.9, then you can only use the 110,000. So, and 1.9 million and over, you're not eligible to make non-concessional contributions. It's important to note that you don't need to meet the work test, so it is just up to the age of 75 that you can make these contributions, and no work test eligibility is required. From next financial year, there's the information there. The cap for the bring forward goes up to 360 to allow people to do the 3 years, and so you can do that if you've got less than 1.66 million. If you're looking to sell your home that you've owned for 10 years or more, we do also have, you have the availability of downsizer contributions potentially. So this is anyone who's owned a home. It could be your spouse, or it can be jointly owned, or yourself who owns it. And as long as it has been eligible for a main residence exemption at some point, CGT exemption at some point of your ownership. So you can have leased it out for a little while, but as long as at some point you have owned that property and it has been able to be exempt because of main residence, then you can make a downsizer contribution. So there's a lifetime cap of $300,000. So that's a contribution. There is no age limit. So you could be 102 and sell your home that you've held for more than 10 years, and you can put in a contribution of $300,000 if you want as a downsizer contribution. You just have to be over 55 years of age, and you need to have held that property for at least 10 years. Like I said, it needs to be exempt or partially exempt from CGT under the main residence exemption. There's only one, you can only do this contribution once, so you can't have previously made a downsizer contribution, even if that's less than 300,000. Only allows you to do it once. And you just need to have made sure you submit a form either before or at the time of making the contribution. If you are doing it through us, let us know and we can help you with that. And the contribution does need to be received by the fund within 90 days of settlement. It is a tax-free contribution, so there's no tax involved in terms of when it hits your super fund, and it also doesn't affect your caps. So if you have more than 1.9 million in your super fund, that you're not restricted from putting a downsizer into super. And if you've already met your cap, you've put in the 330,000, for example, that also isn't counted. So it's quite a useful contribution for people who are selling their homes. Danielle, would you like to talk about the withdrawal and contribution strategy?
I'd love to. I just want to make another point on the downsizer too, that if you want to use the downsizer in conjunction with some of the other contributions, it's really important that you get advice, because you want to make sure you put them in the right order, because sometimes it may preclude you from using some of the other caps. That makes sense.
Excellent point.
All right, so the withdrawal and recontribution strategy, it's there's two main reasons why this may be recommended as a strategy for somebody. And one is to where the members of the fund have disproportionate member balances. So one member may have $2 million, and another member who's been at home looking after the kids or supporting the other member may only have 300,000. So they may wish to withdraw out of the persons with the larger account balance and recontribute it back into the fund for the person with the lower account balance, just to try to balance them out, even them out a little bit more. The other reason would be recommended would be to refresh your member balances. So I can't recall, we go through it a little bit later, is we talk about taxable and tax-free components that everyone has in their member account, and by withdrawing and recontributing back a non-concessional contribution into the fund, you're refreshing and resetting your taxable and tax-free amounts within your member account. So who's eligible to do this? You need to have met a condition of release to be able to withdraw from super. So you must have turned 65, or you're over age 60, and you've ended an employment arrangement. You've also got to be eligible to make a non-concessional contribution back into the fund. So you've got to be under 75, and you've got to be underneath those total super balances that we went through in the previous slides. So less than 1.9 essentially. Obviously you might also need to be able to use the bring forward rules as well. That will determine how much you can put back in. So what's the benefit in doing this? So that second strategy, in particular with refreshing those your taxable and tax-free balances, we don't talk about it a lot, but there's a little known tax that happens when someone passes away and their benefits go to their adult children. So it doesn't happen when you pass and your money goes to your spouse or someone who's a tax dependent upon you. There's no tax on transfer in that instance. But when money goes to an adult child, if the money goes to an estate, the tax is 15% on the taxable component of your member balance. And if it goes directly to the dependent, there's an extra 2% Medicare levy. So 17% is withdrawn prior to the cash being paid out as a death benefit. So you can see there, that's the whole reason why we want to increase your tax-free components. I think we went through most of the things on this slide about the rebalancing, just to make sure that another reason why we'd want to do the rebalancing of the member account balances is because there's a maximum amount that you can put into the retirement phase. So the 1.9 that we were talking about is the maximum that you can have, you can purchase a pension with at the moment. So if you have money in super and say, for example, it is $2 million, you could start a pension with 1.9 and the remaining 100,000 would have to stay in accumulation phase. If we were to use this withdrawal and recontribution strategy, we could reduce that member balance down so that you're maximising your cap, and we're putting the balance of the money into your spouse's account, and then they can maximise their cap as much as possible as well.
Thanks, Danielle. I think another thing to also mention, which isn't on the slides, is that if then in the scenario that Danielle was just talking about, where if you've got 2 million and 1.9 has been transferred into retirement phase, which leaves 100,000 in accumulation, and your spouse has got all of their money, they might have 300,000, and that's all in retirement phase. So you have a small accumulation and the rest of it is in pension. It also means that an actuarial certificate is required each financial year, whereas if it can be this recontribution strategy utilised, that means that all of the money that's within your super fund is then able to go into retirement phase. It reduces that need to have an actuarial determine how much of the fund is going to be exempt from paying income tax. We just also have a note there, another option that some people do, and this is particularly when people are working and are more of work age, is super splitting, where you can split up to 85% of your concessional contributions to your spouse. So it's another option that people sometimes utilise. There's also government co-contributions. This is where the government will match up to 50%. For a maximum of $500 for any non-concessional contributions that are made to the super fund if you are eligible. So there are there's income limits, so upper and lower income limits, and they are on some slides previously that we talked about with the key superannuation amounts. So when you get your slides, you'll be able to see what they are. They're around the $45,000. So if you have adjustable taxable income that's less than the threshold or not more than the upper threshold, and you earn 10% or more of your income from business or employment, and you're less than 71 years old at the end of the financial year, make a non-concessional contribution to super of if it's more than $1,000, then you'll get up to a maximum of $500. That money will just, once your tax returns are lodged, the super fund tax returns or your personal tax returns, that will trigger the ATO, and they will pay that directly into your super fund as a non-concessional contribution or as a tax-free contribution. So if you have got income between the lower and upper thresholds, the entitlement is reduced by 3.33 cents for every dollar greater than the lower threshold. From an eligibility point of view, total super balance does need to be less than the general transfer balance cap, which is currently $1.9 million. And it is only really for Australian citizens or New Zealand citizens or have a prescribed visa. So not if you hold a temporary visa. There's also low income superannuation tax offsets. This is, again, it's up to $500, and it's for people who are who are receiving low income, so less than 37,000, and you've received employer concessional contributions to a complying super fund this financial year, then the government will pay up to $500. So that's another, again, it is automatic once personal tax returns are lodged. Transfer balance cap is currently at 1.9 million. It hasn't indexed this financial year, but there is an expectation that it will increase to $2 million sometime in the next financial year. We haven't been told when, but at this stage it's remaining the same. So the transfer balance cap is the maximum that you can put into retirement phase. So currently, whilst the transfer balance cap is 1.9 million, that's really for new entrants to retirement phase. If you already have if already transferred money into retirement phase, then you have your own personal transfer balance cap. So there's a formula, and it can be a bit complicated. So if you're not sure what your transfer balance cap is, you can hop onto your MyGov account and have a look through ATO. That should be listed on there, or give your accountant or us a call, and we will be able to assist you with that. So typically, if you've used up your entire retirement cap back in 2021 when it was 1.6 million, that doesn't mean you now have $300,000, unfortunately. So it's more if you're new to moving into retirement, then your maximum cap is going to be 1.9. But if you put in some, and let's say you've put in $800,000 when the cap was 1.6, then you've used 50%, and you can use up to 50% of the increment increases as well. Can be a bit complicated, but there is everyone does have their personal transfer balance cap, which we can provide for you if you need it. Minimum pension requirements. So each financial year, the ATO require people who are in retirement phase to take a minimum pension from their retirement phase balance. So during COVID, these amounts were halved, which did help people. That didn't mean they didn't have to take as big a pension if they didn't want to. That has gone back to from this financial year 2024. They have gone back to the legislative requirements. So these limits are here. If you're under 65, it's 4%, and it just gradually goes up. If you're between 75 and 79, you're required to take 6% of your balance that's sitting in retirement phase. If you're 85, that's 9%. So this is, like I said, it's legislated. These are the minimum. There is no maximum. In terms of if you've got an account-based pension, the maximum limit is really just your member balance. But it just that you are required, if you want the income tax exemptions, you are required to take at least the minimum. If you're on a transition to a retirement pension, so this is for people who are typically working and want to supplement they want to sort of slow down and work less days, but they would like to supplement their income because they still have got their expenses, then they can enter what is called a transition to retirement pension. And this allows them to take so this will be for people who are under 65. So this allows them to take between 4% and 10%. So that the transition to retirement pension, not in retirement phase, does have a maximum limit. But an account-based pension, so most people who are in retirement phase don't have a maximum. So SMSF and related party issues. This is something that we are finding more and more auditors are being sort of cracking down, I guess, and just there's a lot more rigor around what, I guess, with regards to related party leases and loans or any related party transactions. This is because the ATO have sort of changed their stance, or are really monitoring this a lot more. So in terms of rentals, we need to ensure that leases have CPI increase. They don't accept that a lease that doesn't have any sort of CPI or percentage increase is commercial, and rent needs to be based on independent rent appraisals with comparatives. The prepayment of rent is something that needs to have a trustee resolution to provide, to record why it's appropriate. This is only like with related party. If it's not related party and your tenant chooses, if you've got property in the super fund, your tenant chooses to prepay rent, then that isn't an issue. It's more around the related party. The ATO just want to make sure that you're remaining on commercial terms, and also property expenses, that they are paid as per the terms of the lease. They also look at loans. So where the SMSF is making a loan investment to a related party, they want to ensure that the auditors are looking for documentation that the loan agreement is at commercial rates, that the repayments are what would be expected if you were acting on an arm's length, and same with interest. Any interest that's applicable, that it would be what you would consider if you were working on arm's length. It does require mortgage to be registered, and they do like to have a loan agreement in place. The other thing they look at in terms of private unit trust investments, so this is a really common, we have a lot of SMSFs who have unit trusts that are sort of related. The ATO or the auditors have a look-through approach. They want to make sure that the assets are valued at market value, just like the superannuation, so the SMSF assets. So any assets that are held in the unit trust do need to be recorded at market value with, if it's a property, for example, it's the same requirement. It has to be a independent valuation with comparatives. The trust distributions is something that you need to ensure that all trusts are distributed to the unit holders before the 30th of June the following year. And if you can't reinvest the cash, or you don't want to, if you don't want to distribute the cash, or you can't, you can reinvest it for more units. It does need to be done at market value. And where a property is leased to a related party, all terms must be on an arm's length basis. So this is even where a property is within a unit trust. If that property is leased to a related party, we do need to make sure that the lease terms are in accordance with what you would expect if you were acting on an arm's length. With private company investments, we're finding the auditors are pushing back a little bit in terms of qualifying audit reports where they can't determine the value. So this is if the private company financials aren't audited, then we're finding often that the auditor is qualifying the audit report because they can't substantiate the value or substantiate that it is recoverable. And so they're taking a very cautious approach. This is based on some the fact that they have been facing being sued for action where someone has lost some money in a private company, and they felt that the auditor should have informed them that it was a risky investment, and now they are taking a very, very cautious approach. Danielle, have I missed anything there with regards to related party issues?
No, I think you've covered most of the points there. So I think, and most of the clients that we have probably, we've been through some of this over the last few months. So
one thing I didn't put is if you've got a related party loan, and I think we do talk about this a little bit further down, but if you've got a related party loan for an LRBA, a limited recourse borrowing arrangement, so you've borrowed, the fund is borrowed to buy a property, for example, and it's actually borrowed those funds from you personally or from a related party rather than from a banking institution, then all of the loan agreement, needs to be in line with what is the safe harbour rules, which the ATO have released. I don't know if you've heard much about NALI or NALE, so non-arm's length expenses or non-arm's length income is also something that the ATO do look at really closely. So what is it? It's non-arm's length income is income that's received by the super fund that is greater than the amount than would have been expected if the parties had been dealing on a commercial basis. For example, if you've got a property that's rented, a commercial property that's rented to your business, and your business and the valuation of that rent says that the market value says that the rent is $60,000 a year and the business pays $80,000 a year, then that is more than would be received if you were dealing on a commercial basis. And that could fall within these non-arm's length income regime. Any non-arm's length expense is where any loss or outgoing or expenditure is less than the amount the entity would have been expected to incur had they been dealing on arm's length. So if there was you were a painter and you were painting the property and you didn't pay for it, the fund didn't pay you at market, then that is less than the fund would have expected to be dealing if they were dealing with you on arm's length. So if fall foul of these rules, the income is taxed at the highest marginal tax rate. So you no longer are paying 15%, or if you're in retirement phase, 0%, actually going to be paying 45% in the dollar. So some examples that we have seen of NALE or NALI are in terms of income. So it's trust distributions, where the trust distribution income from unlisted trusts is higher than expected. That is where there's the income of the trust is actually coming from another trust and another trust, and it really is a bit of a scheme to get money into the super fund, where rent is received more than market value, like I mentioned before. And if there is a loan that is with a related party and the interest income is not at commercial rates, then that can be considered non-arm's length income. In terms of expenses, non-arm's length expenses, rent receiving less than the market value. If the expense, I made the comment about a painter, another example is a real estate agent not charging market value for managing their rentals, and that real estate agent is related to the fund, that can be considered a non-arm's length expense. For me personally, as an accountant, if I was to prepare my SMSF accounts, financial statements, tax return, and I didn't charge my super fund, or sorry, my business didn't charge my super fund commercial rates, then I also would fall foul of these rules. Another one is trades. So this is a really difficult one for people who do own property and maybe an electrician or a plumber or a builder, and they think on the weekend I'll just go and fix it up. They actually have to invoice at commercial rates, or if they've got a related party, people who might be their son that is a plumber or a painter, they have to charge and invoice at commercial rates. Just looking at rollovers, we just thought we'd add this in just to give a bit of, just to remind people if they're looking to consolidate their super accounts or move from a public offer or retail super fund into an SMSF or vice versa. Before any rollovers are made, it's just important to consider both insurance and any implications of if you've made a deductible or a super contribution through that financial year. So if you have an insurance policy, life insurance policy within super, and you are looking at rolling over to another super fund, if you're looking at rolling over the full balance, then that insurance that's held in that super fund will be cancelled. So that can be an unintentional sort of problem that people face. So you just need to consider if it's appropriate and potentially seek some financial advice just to make sure that you are insured. If you have made contributions, so let's say you decide to establish a self-managed super fund and you want to roll your funds from a public offer fund into an SMSF, or maybe you have employment that has to, your contributions have to go into a specific super fund, and then you want to roll it into your SMSF, then you just need to be careful in terms of if you've made super contributions and you're wanting to make a deduction claim a deduction for those contributions, that you have got a notice, you've applied for a deduction and you've got a notice of intent to claim. You need to receive that acknowledgement before you roll over, otherwise it'll be treated as a non-concessional contribution and you'll lose the deduction. I thought we'd talk a little bit about limited recourse borrowing arrangements. So typically super funds aren't permitted to borrow except in very limited circumstances, and one of those is a limited recourse borrowing arrangement, LRBA. We like our acronyms. So there's a few things to consider. We've got a little diagram on our slides which just explain how it works. So in terms of the legal ownership, so if you wanted to buy a property, for example, and you wanted, let's say you had, I don't know, $500,000 in superannuation, and there's a property that you're wanting to buy, and potentially it's $700,000. So you need to borrow some money to be able to purchase that. Then a separate entity actually needs to be established. It's called a bare trust or a holding trust, and that entity holds the trustee of that trust holds the legal title of the property. The SMSF is the beneficial owner, so it's a very specific trust that holds the property and specifically says that it holds the property as for specifically the SMSF. The loan itself is in the name of the super fund, and any repayments goes from the super fund to the lender, but it's just the actual property is held in this separate trust. There are some rules around it. It can only be for one asset, so they call it a single acquirable asset, so it does need to be only on one title, and there can't be any other chattels included in the contract. Or if you can actually do it to purchase units or shares, and it just needs to be a separate parcel for each bare trust. So example, you can buy 100 BHB shares, and that can be under one bare trust. If you're wanting to borrow to buy some CBA shares, for example, or Commonwealth Bank shares, then that would have to be under a separate bare trust. There is some different rules in terms of from the banks. Some of their LVRs are a bit different. Some will allow up to 80%, some prefer 60 to 70. We do need to ensure that your investment strategy is updated and that your deed allows for borrowings. You can purchase business real property and a tenant can be related. Just need evidence that it's on market rates, so we're not having any problems with non-arm's length. You can go through a bank in terms of lending, obviously, a banking or a lending institution, and with limited recourse borrowing arrangements, you can also get finance from a related party. Still have to do it through a bare trust and all that, but you do need to comply, though, with if it is a loan from a related party to finance the purchase, then you do have to follow the safe harbour guidelines that the ATO have specified to ensure that you're compliant. And I've got a list here. If you've got property, the LVR is 70%. So even though a banking institution may allow to borrow up to 80%, if you are financing through a related party, the maximum that you can lend is 70%. The interest rates are as per the RBA indicator lending rates, which are currently 8.85%. And each year, if your loan agreement says that it's variable, each year you have to update the percentage based on the indicator lending rates. You can fix the rates for up to 5 years. The maximum term is 15 years. The mortgage must be registered. It must be P&I, so it's principal and interest, not just interest only, and you need to have a loan agreement. Again, if you're financing and you're wanting to do shares, then there's some restrictions there as well. It's a maximum of 50% LVR. The maximum term is 7 years, and the interest rate is actually whatever the rate is plus 2%. So currently 10.85%. Some proposed super legislation that's coming in. It's called the Div 296 tax. I might hand it over to Danielle to talk to you a little bit about this new tax.
Thanks, Shona. Yeah, this proposed legislation was announced in the budget, not the one we just had in May, but the year before, and it's still floating around, and we're hopefully have an update for you later this month because they're sitting in Parliament this week and next week. This tax is proposed to apply to superannuation members who have a total super balance of more than $3 million. So remember, that's your balance across all of your super funds. Whether they're in pension phase or accumulation phase, it's that total balance. Now, the proposed tax is going to apply to any earnings that are attributed to your member balance that's above the $3 million. And your there's obviously formulas that they proposed for the calculation, but just to make it as simple as possible, it's your they look at your total super balance and they take off your super balance at the previous financial year and to calculate your earnings. And it includes your unrealised gains from investments, but excludes your contributions, rollovers, and pension payments. The ATO will make these assessments once they've received all the information, so from the lodgement of your personal and the super funds tax returns, and issue with an assessment, just like they do with the Div 293 tax. You can choose to pay it personally or release the money from super. I think we've covered that slide, yeah. Now, it's due to commence on or after the 1st of July 26. So any gains or losses, so we're talking about whether it's realised or unrealised from your investments that happened prior to 30 June 25 aren't going to be considered. Where your fund's assets decrease in value, so say you had $5 million at 30 June 26, and then at 30 June 27, your fund decreases to $3 million because the investments that you hold have not necessarily tanked, but just there's a different valuation. Say you've got a property and it's been flooded and it's decreased in value, then there's negative earnings in that year. The loss will carry forward to reduce future earnings, so you don't receive a credit in that year. So the 15% tax will apply to your balance that's over $3 million. So they're using a proportionate method, and I think we've covered that where it's assessed on all your super funds across your balances in Australia. If you've got an LRBA in your SMSF, then the loan value is added to your total super balance. Because if you think about it, when we report the property value at its market value in the fund's accounts as an asset, and we report the LRBA liability as a liability in the fund's account. So when we're your member balance is net of those two amounts.
Yeah, so they're going to increase your member balance base, so they don't take into account, your the loan amount.
Yeah.
Thanks,
Yes.
Dan. Like I said, it isn't legislated at this stage, and we will provide more information when we've got the details. There's a lot of lobbying going on behind the scenes trying to change it, but at this stage it's been pretty unsuccessful. So we're expecting that it'll go through, and it's probably in its current form, but we'll provide more details as it comes. Another proposed superannuation legislation is payday super. So this is for employers who have got employees who they pay super guarantee for from 1 July 2026. The proposed legislation is going to state that employers will have to pay employees super at the same time as they pay the salary and wages. And the expectation is at some point that also the withholding tax will also need to be remitted to the ATO at the same time. So they're looking at really real-time data, real-time payments. So this will have a bit of an impact to employers, particularly from a cash flow point of view, because currently they only have to pay super quarterly. It does mean that employees are getting their money in their superannuation accounts in real time, which is a benefit to them. So some things that employers might look at doing is changing their payroll reporting period. So it might do pay weekly, and they may move to sort of monthly because there's going to be a lot more paperwork involved in terms of having to lodge superannuation a bit more often. The other thing, I guess, to smooth the impact, what employers could start doing is already start introducing a more frequent superannuation payments so that the impact to cash flow in July 26 won't be as great. The final thing we were just going to let you know is this is an ATO update, is that the ATO has recently introduced an SMSF bank account validation for super contributions. So we have noticed this has affected a few of our clients where they are paying their superannuation into their so they're paying from a related party, particularly. It's happened, but it doesn't matter if it's not related. The superannuation is going to an SMSF bank account that the ATO doesn't have recorded. And so if it's not recorded, then it's failing its validation, and that contribution is being rejected. So there needs to be a perfect alignment between the bank account details that the employee has given for the super contribution to the bank account that is recorded with the ATO. And sometimes that differs just because the super fund might have a couple of accounts and the ATO may have a different bank account for recorded that they pay refunds, for example, into. So it's an easy fix. We just need to go in and change the bank account for the ATO in the ATOs to align with the bank account that the employee has given their employer. Validations are always good, so it does make sure that the superannuation contribution that the employee is potentially receiving is actually going to the correct bank account. So it's a good thing, but it is catching a few people. So that's the end of the presentation. I am just going to pass it over to Deb and see what sort of if there have been any questions.
Shona, there haven't been any questions in chat. But I've got some questions that we had from the live version this morning, if I can ask those of you, if that's okay.
Of course.
So the first question that was asked this morning in the live session was super contribution. You said 30th of June was a Sunday. What date do we need to make the contributions to ensure the fund receives them?
So it depends whether you're paying from your personal bank account or whether it's employer contributions and it's going through a clearinghouse. So if it's employer contributions going through a clearinghouse, the clearinghouse will typically dictate what dates. I'm pretty sure 0 was yesterday in terms of contributions cutoff date. But because it does need to be received by the super fund's bank account by before close of business on the 28th of June. So you do need to make sure those contributions are in. If you're making personal contributions, you need to allow a couple of days for the transfer from one bank to another, because even if it's come out of your bank account, if it hasn't actually been received by the super fund's bank account, it's not a contribution in this financial year, unfortunately. Good question.
Second one, we've only got 3. So second one is, how will I know if I've met the minimum pension for the year?
Good question. So Danielle, if you have an SMSF with us, Danielle has definitely been working through the list of our clients who have got a pension and retirement phase, and just making sure that everyone has met the minimum and is reaching out to those who haven't. Some people have got a pension payment planned for the 26th of June, which is great, but we have been reaching out to everyone. So it is making sure. I have on the slides the minimum pension requirement. So it's your member balance on the 1st of July or 30th of June the previous year, and it's multiplying it by the percentage factor. So if you are 70, then it's 5%, and you would just need to make sure that. But get in touch with us if you're not sure, if you have your super fund with us, and we can certainly make sure.
Shona, one last question. Can you clarify the work test eligibility?
Sure. That is for people who are wanting to make deductible contributions. So you can make non-concessional contributions up to you turn 75, which is after-tax contributions. But if you're wanting a deduction in your personal tax return, then you need to meet the work test, which means you have to work at least 40 hours over a 30-day consecutive period. And it does, they define it as gainful employment, so you do need to receive income for that employment. It's only for age 67 as well, 67. So if you are 65 to 67, you've retired, then you don't have to meet the work test. You can just make a deductible contribution and claim that contribution in your personal tax return if you've got enough income.
Brilliant. Those were the 3 questions from this morning. So, and there's nothing in chat. Thank you.
Thank you so much, everybody. It's been a pleasure to have you in our inaugural webinar. Thanks for joining. If you've got any questions, feel free to shoot an email through to myself or Danielle or the team. We're here to help, and hope you have a great day. Thank you.